If you don't start today, you're never going to start to make progress towards that long range goal. So you just got to build it into the DNA of how you go to work every day. That's what separates success from failure.
All right, welcome to today's conversation. We are discussing why everyone who has an agency should be selling their agency. This is a bit of a controversial topic, so I didn't want to have to stand on my own. I've got some credentials, but I've also brought Dan Duran onto this conversation so that we can answer the question why you should sell your agency. Dan, it's great to see you today.
Shawn, great to be here. Pretty excited.
Let me do a little bit of background if I can. I'll introduce myself, and then I'd love for Dan to give his own bio and some points of credibility of why we're in a place to talk about this today. I am currently the CEO of my third agency that I've built, and the first two agencies I've sold. I sold the first as a roll-up, kind of an acquisition of my client list, back when I was young, fresh, excited about the world, and knew very, very little to nothing about the M&A experience. The second agency I sold, I was a little older, a little wiser, think I did it better, and we were able to exit that agency along with, I had three partners when we structured that, and we left for a comfortable mid seven figures valuation and an exit a few years ago. Since then, I've been helping other people in the agency world to know how they can scale their current agency, grow their business, and functionally how to set themselves up for a better sale of the business, a better exit than the experience that most people walk into. So I've seen a few of these, I've been in some, and I've been on I'm the guy trying to sell side of it. Today, I get to be more of a spectator as a consultant to seeing that business transaction occur. And that's why I want a guy like Dan, who's been on the other side of the table for countless of these and seen how it's supposed to work. So Dan, again, grateful for your expertise and excited to get some chances to force you to share some of your insider tips with us in this conversation today.
Yeah, right on, man. I'm like I said, I'm happy to be here. And unlike you, I have spent the last 20 years working in this in the world of transactions, between running M&A deals, running valuation assignments. So whereas I always think it's important to know where your your expertise and what you're an expert at. So you, Shawn, you've spent a career in, various worlds of marketing. And, I would always think, look at you as like, you're the expert in that domain. Like I can talk about it a little bit, but I'm never going to, carry your experience that you do to a conversation. Likewise, the reason I'm here today, I guess, is I spent 20 years doing nothing but transactions. So hopefully we will have an interesting conversation, and we'll take it from there, man.
No, I don't see how this could be anything but interesting. I agree with you wholeheartedly that it's important in life to know yourself, to know your strengths and your areas of expertise. The flip side of that is knowing your weaknesses, knowing where you need someone else to step in. And my success in business, whenever I've looked back on it, has been knowing my limit and finding somebody who's good in those other areas. So I've got opinions to share. I've got lots of thoughts on the whole idea of when you should sell an agency, how you should sell an agency, how much you should sell an agency for. I think we're going to cover all that. But let me start you off with the thing that's most on the minds of me, of our audience. The conversations I've been having, especially in the agency world, are that we're looking down the road at some unprecedented volatility in the market. I just read that September 13th was the worst day in history of the Dow, and that we're on track to the worst Dow and market recordings that we've ever seen.
Yep.
So I would love to hear your thoughts as you're discussing agency exits for agencies that are in a position of moving through this sort of transition, but looking down the pipeline of what the economy is doing right now.
Yeah. So I guess a couple initial reactions, and we can go deeper on this. But the first is, I think for most of your audience, we're talking about private capital markets, not publicly traded markets. Exactly. So it's important. It's important to separate this because, well, private capital markets track to publicly traded, public equities slightly. There's a correlation, but they're not, equal variance. So you don't see as much volatility in private capital markets as the public markets. And, taking that a step further, the farther you are down in the value chain, the more moderated and muted the effects are. So, if you look at your agency today, or what you said, September 12th or whatever the day was, the Dow had a terrible experience. I'm guessing that your agency and most agencies didn't even notice. Right. There is no correlation on a day-to-day moment-to-moment basis.
Absolutely. Yeah. I had to look that fact up in preparation for this conversation.
Yeah. So, but take it a step further. Where it starts to matter is the follow-on effects. So to the extent that macroeconomic climate impacts the fortunes of an industry, the transaction world is probably going to follow that. So
So you're saying the sky isn't falling, but we should be looking at the larger trends.
Yeah. And so think about where the larger trends go in, advertising, marketing, et cetera. That budget gets cut pretty quickly when large budgets get cut, right? So you expect to see that industry revenues are going to have some negative pressure, some downward pressure on it. So, financial fortunes will fall to some extent correlated to a large, broad, retrenchment in the economy. So there's going to be some headwinds, right? But that doesn't mean the sky is falling. It's just something that you've got to manage through.
I think that's great. That's great perspective to remember that you're running your own race, and those individual factors that affect your business don't necessarily stem, I think, from that macroeconomic environment that we're looking at. So I still want to hear from you. How do you prepare a business for what we...
Well, hold on. Let's backtrack, though, and talk about the impact of the economy and economic trends on transaction market, right? So before you even get to talking about preparing, if you look at the last 3 years, and actually the last economic cycle, it has been a historically great sell-side, in transaction market. And when I say that, I mean like sell-side meaning you're on the side of the table where you're selling your agency, not the buyer. It's been a seller's market. Transaction accounts have just been, through the roof. Debt has been cheap. Capital has been available. So it's been a really healthy environment to go to market. The trend, though, that we see, not necessarily in advertising marketing segment, but just M&A, private capital markets in general, is I think we've seen a cooling off. And it's hard to say because, the data isn't like looking at the Dow where it's ticking moment to moment. What we have to do is sort of parse the tea leaves and see what we're seeing. So I think we've seen a bit of a slowdown in 2022. And if you ask me to place a bet, I would say 2023 is not going to be a great deal market, right? So fortunes are down. If our industry revenue has fallen a little bit, maybe earnings have fallen a little bit, so deals look a little bit less attractive. Debt is more expensive, less either less equity capital available or more cautious equity capital. So if you look at that, I think you see a big slowing of the transaction market going into the next 12 to 18 months. And, it's probably going to take that long to start to see, hit the bottom of the U and come back up again.
Interesting. So yeah, that's what we're buckling in for, is more of a year for, it would be more of a year for growth and for investment into your own business.
Yep. So you were starting to ask the question, like, is now the right time to sell? Or, I don't want to steal your phrasing here, but, the counterpoint to this is that we always say that good businesses always sell in any environment. So if you're a company that is outperforming your peers, outperforming the market, there's no reason that you can't do a deal in 2023. On the other hand, if you are an underperformer, you're in the lower third of the population, you're not throwing off, great numbers, you are, in an industry downturn, you're turning down further than the industry, it is not your year, right? Like you should definitely buckle down for growth unless you're in fire sale mode. Like you need to dump this, you're thinking about a bankruptcy, like all the doom and gloom. That's the only reason that you should go to market if you're that lower third next year. It's the top performers that, deals are still going to get done. And if you have done the work and you're well positioned for a transaction, by all means, look at accessing the market.
So if you can afford to wait, now's the time to be looking longer term. Now, when you're thinking long term, what time periods are you seeing as being ideal?
2 ways to answer that question. One is, just from a macro viewpoint, any company. If we're in an industry downturn, expect that it is 18 months from now, going into 2024, I'm rounding here a little bit, is probably when you start to see the market as a whole come back. But I think you also have to look at this as, the individual company, right? How long is it going to take? Well, how bad of a position are you in today? If you are reasonably well postured, mid next year, you can probably look at starting to head back out to market. If you are not postured well at all, 3 to 5 years, it's a long road to get positioned well for a baller transaction.
Now, what if I'm looking at that baller transaction? Let's flip the table. Now would be an ideal time to be preparing for acquisition of some of these people who are going to fall into that lower third.
Yeah, it's a sexy and attractive and alluring thing to think about. It's challenging to do. So I would be cautionary on this. Companies that are good at acquisitions build the infrastructure to do acquisitions and do more than one. So if you're thinking about going out and being opportunistic and buying one agency, your chances of success, every Harvard Business Review article you read is about the, integration failure and, failure to deliver returns on acquisitions, right?
Sure. Yep.
You do one of these, your chances of winning, it's a toss up, right? Like maybe it'll work, maybe it won't. If it's small enough, then maybe you can roll the dice on it. If you are serious about growing through acquisition, you mentioned you sold to a roll-up. They did 5 or 10 or 20 different deals to get to, whatever point, probably before they sold up to the next level. They built the infrastructure to do deals, and you get good at doing deals. So where this leads me is, if you're thinking about being opportunistic, I would encourage you to, one, get your house in order and position your company, to be in a position of strength, solid financials, good customer base, recurring revenue, all the themes that we see that lead to strong valuations and resilient companies. Make sure you do that before you go out and try to do a bunch of deals. Don't be a cowboy, right?
No, it reminds me of the adage, if you're trying to outwit the car dealer, remember you're buying one car every 5 years. He's selling a car several times every day.
Yeah, absolutely. I mean, so when you look at, from my viewpoint, sitting in the middle of running transactions, look at the information asymmetry that is in this ecosystem. You have buyers that most of the time have done multiple deals. So they're smart, right? They're smarter than the seller.
Yeah.
You've got me or somebody like me who's done this, hundreds and hundreds of times. So I'm probably more experienced than the vast majority of buyers that are doing a deal. And I'm almost definitely more experienced than the seller who's going to do this likely one time. I mean, you're the exception to the rule, right? You're on your third one of these. That's the exception to the rule. So there's this big asymmetry of experience and knowledge and the learning curve that goes along with this. It is, you've got to be careful, reading the room and not, falling into a game with a card shark, right?
No, I heard a strong note of caution there. That was a healthy caveat for the whole acquisition game, because it's easy to see a fire sale and look and say, okay, we're in a good place. Let's see what else is out there, as a positive in a bear market. But I think that it's easy to take that advice that applies to mutual funds and misapply it in this specific industry. So I think that's well noted to recognize what you're playing up against. And it almost drags in the metaphor of for sale by owner, like in real estate, because I've often seen people saying, oh, I think I can do this and save my, 3%, 6%, whatever it is, commission. And when there's more at stake, there's certainly more people who are better at playing the game.
So, I mean, look, I'm biased in this. I truly believe that, people that do what I do for a living derive an incredible amount of value in transactions. So trying to be cheap and saving X points on your transaction and DIYing a transaction, selling a company is way harder than selling a house. Like, you've got to be confidential about it. The mechanics of it are completely different. It's just massively different. So to try to DIY this, if you've got a really small agency and you're essentially selling your job to somebody else, by all means, go for it, do your thing, give it a try. There's not a lot of risk of breakage. But if your number that we're talking about is 7 figures, 8 figures or above, then trying to DIY this is a recipe to lose a lot of money.
Yeah, it's too big of a gamble to play with that much money. So, and my summary on that is see the market the way it's coming. Don't try to outplay the market. Don't sell when it's low. But maybe this period when it's low is a great time for expansion of your own agency, and to see, certainly we're going to see that impact competition from agency to agency. So if you're in the expansion phase, I guess is my segue into my next question is how do you take a agency that's doing well, right? That's already been effective and play for the best possible results during what you see coming.
Yeah, we could go deep on this. So if I'm sitting here and I'm an agency owner and I've kind of made the decision that today is not the time to go to market, and either I'm not well positioned or I'm uncomfortable with what the market is likely to hold, there's a playbook to run, and it starts with understanding like where your value. And I know we're going to talk a little bit about valuation here.
Yeah, dive into
it starts understanding where your value is today. You've got to get that baseline number to understand just how far you have to go to get to whatever your goal is. And it's not complex, right? If you wanted to drive from here to Florida, you have to know where you're starting from in order to get directions to get to Florida. And
right.
it's the same thing with value, right?
Yeah, exactly. Play this game.
Yeah, and I've wound up in Newark before. You don't want to do that. I'm a Jersey guy, so be careful. How much further we go on this. But look, so you get your starting point, and then from there, a couple of things that we want to do. One, we want to de-risk the business, right? So we know we're going into a period of stress. We want to understand where the risk profile of the business is, and then be proactively de-risking areas of the business that are potentially treacherous. So like I always think like protect this house, right? So understand where you're starting from. Do the things that are protective and defensive in nature, so that you have a resilient asset. Next is we want to start thinking about the things that position you for that, whatever that goal, whatever that number is that you're heading towards. That kind of looks like growth, right? So we've got to get in growth mode. We need to have a focus on profitability. We need to build a company that is attractive to a buyer, right? So think about, when you're looking at an agency or when you're working with an agency, what are the elements that are attractive? Just throwing out some ideas. One, owner dependence. If you are a single point of failure, or you're still billable on, in client matters, that is not a good thing, right? Like I'm buying Shawn if this were the case. And that's risky for me as a buyer. That's going to negatively weigh on the valuation. So you can continue to go through like a whole series of these things, and that sort of comes back to de-risking, but get Shawn out of the billable seat, some middle management in there so that there's some resiliency in the organization, build out a sales model that can repeatedly drive new business in through the company that isn't reliant on, luck or word of mouth or the things that we really don't like. There's a whole litany of actions that we want to start to take. And you can see why, I've said, these just random bullet points that I'm throwing out. All of these would take time, right? So when I mentioned earlier, like this could take 3 to 5 years, depending on how far you need to grow from today's value to that goal number, that's impacted by time, right?
Dan, you just shared a list that apparently comes right off the top of your head from having done this for 20 plus years in the M&A industry. But for those of us who don't think the way you do, what resource do you steer them to, or what's the starting point for knowing how to take your agency today and prepare it for something that would be what you called something someone else would want to buy?
Yeah, I mean that's why we built Value Scout. Value Scout is a SaaS application. You log in, brings you through valuation, understand baseline where your numbers are sitting at today. We'll start to kick out a series of recommendations on things to work on, and from there, that becomes your the place that you live to work on these value creation type initiatives, building your agency and positioning for a sale.
So what I'm not hearing you say is, go to YouTube or go and Google this and just try to again DIY tackle this on my own.
Yeah, I mean, look, I love going to YouTube and DIYing things. I got a 77 CJ that I wrench on. If I got to figure out how to change the rear main seal on it, I'm going to YouTube first. That is something that is not exactly critical to my life and to putting beer on the table long range, right? If I fuck it up, I can still bring it down to the mechanic. Selling a company, when you mess that up, it's going to be hard to recover from that, and the learning curve is too steep. So by all means, go to YouTube and get smart, but let's pad the averages. You need to surround yourself with professionals who have been there and done that and are going to shepherd you through this process so that you don't screw it up and you can put a large amount of beer on the table at the other end of this.
Now, you mentioned something that's interesting. By the way, I love that your table doesn't have bread on it.
I don't even know what you're talking about. What kind of table is that?
You've talked before about getting a starting point or knowing today's value of your agency. Talk about why that's a critical place as far as this conversation.
Well, one, just back to the map analogy, like you just have to know. It is foolhardy to start working towards a goal and not knowing where you're starting from. Like, if you're a fat kid and you want to be a less fat kid and you have some sort of goal, like getting to 152 pounds doesn't really mean a lot if you don't know where you're starting from, right? Any one of these analogies you want to use, it still kind of comes back to that.
Right.
Second, depending on the size of your company, probably makes sense for like some estate planning purposes. And I don't want to go down the rabbit hole too far on estate tax and these sorts of things, but understanding valuation, doing some gifting strategies, getting a portion of your ownership out of the estate, locking in value. Now, there's a lot of smart things that happen that are tied to initial valuation and at the lowest point. So, just tactically, there's good reasons to do this as well. So yeah, I mean, to me, it's just obvious that we've got to start with that as the beginning. But there's just, follow on, reasons that continue to expand from there.
Well, let's talk about those. So I'll be honest with you. Some of the agency owners I talk to are asking, why do this?
Yeah.
Why sell? So they think they know what their agency's worth. They think they have in their head that they're not going to get that out of the sale, so they're feeling like they need to stay with that business.
So some golden handcuffs. So look, here's the deal. Why should I sell my agency? Well, you shouldn't unless you want to, right? Like
that's a great answer.
If you enjoy what you're doing every day, why would you just go sell the agency? Like that's just dumb, right? Like I like my car. I drive down the street in it every day. I really enjoy it. I should go sell it. Like that's just dumb, right? Like we wouldn't do that. So the flip side to this is eventually you will no longer own your agency. Full stop.
No, right? That is huge. That's a hard moment for a business owner who has his identity, and this is talking autobiographically, Dan, tied up in their business ownership. It's putting the own in ownership when you say, this is my own, this is my baby, this is my identity.
Yeah, but look, statistically, 100% of owners leave their company, and you either die at your desk or you do it, ideally more on your own terms. But statistically, there's a meaningful number of companies, not just agencies, companies that transact ownership not on their own volition, right?
Right. And involuntary transition is the term I've
we think of it as the D's, right? Death, divorce, disability, disagreement. There's one other D and I always forget.
Dismemberment, I think.
Now that's morbid. However, Um, we're in today's discussion, we've been talking about a sale, but really what I like to work with owners and founders towards is it's not about the sale so much as giving yourself optionality. So if we do the things that make my company worth more, make it attractive to an outsider, either at the time and place of my choosing, when I'm no longer excited about running my company and I'm getting bored, then I can transact at the price and terms that I want to. So that's, option number one. Option number two, I run into one of those Ds. Well, again, I have positioned the asset to be resilient and to be able to transact if I get hit by a bus, right? So not the outcome that we're looking for, but at least it's an outcome that is acceptable to all of those people that I'm leaving behind. And then, finally, at some point in time, you are going to make that decision that, I affirmatively want to go do this. And again, we know that it's going to take a period of time. The flash to bang on this is not like, hey, I'm going to run through a checklist today, and by the end of October, I'm going to be market ready. In most cases, you're not, or you're not going to be happy with a number. So you got to start putting in the time now in order to get to the other side of the rainbow, on terms that you're looking for.
Got it. No, I think that's valuable. In my own experience, we sold too fast and for too little.
Yep.
And that's what I'm trying to prevent this time around. And I love what you said about, being able to have a little more control over the time and the conditions of your choosing. When we work with any agency, we want to see that certain indicators of success are in place, and we want to start doing the de-risking that you identified earlier.
Yep.
So I want to talk about how those maybe as levers play into determining what an agency is worth today, and then the levers you're able to pull and work with to determine what that agency is worth down the road, especially as we've talked about playing this longer term game as the economy turns.
Yeah. So a couple thoughts on this. I want to separate the concept of value and price. And we'll come back to this because the next step is actually like running a transaction, right? And
no, this is huge. Great starting point.
So I always think of this as value is analyzed, right? Like we go through a process to figure out what something is worth today, but there's not an actual check, right? Like nobody's writing the check and saying it's worth $1 million because here's your check for $1 million. Price is negotiated. Price is what happens between two parties that are, usually with an unequal knowledge of an asset that are working towards transacting it, exchanging something of value for something of value. That's price. So at the early stages of this, we're focused on value. And eventually when we run a transaction, our goal is to go from value of, sort of this middle of the road number and negotiate price higher than value. So pause on that piece. We'll focus on value for a second. And did that make sense what I'm talking about? Like how these two things are separate?
No, it's beautiful. Back to force your example of the car. You're driving a car, and that car is worth way more to you because you're getting the utility of it, right? Than the price you'd be able to go out and negotiate with for someone else, because now you're taking your standard of utility against their standard of valuation, and you're determining a price. I appreciate that. And again, these are things I wish I'd had explained or spelled out to me at earlier points in my career, because it makes a big difference when you share that understanding.
Yeah. So let's talk about then value. Mini valuation lesson, easiest valuation lesson in the world. 3 variables that you can pull on for increasing or decreasing value: earnings, growth, and risk. Some people like to use the mnemonic EGR, EGR, earnings, growth, and risk.
Beautiful.
I didn't come up with that.
It's very memorable.
I'm the earnings, growth, risk guy. And somebody else was like looking at my notes one day and they're like, oh, you mean EGR? What are you talking about? Anyway. So that's it though. There is a lot more that goes into actually assessing the value of a company. Like how do we understand that it's worth $1 million or $10 million or $100 million? There's math that's involved there. But directionally, those 3 variables are what get us there. So think about that. Risk is easy to understand, hard to quantify. But directionally, if we have a element of risk present in a business, I talked about Shawn being the single point of failure. Well, if we lessen Shawn as the risk focal point there, we diversify, we diversify things away from his day-to-day job and role.
That's my sandbox, but it's critical to take that away from your key role.
So we are de-risking the business there. We are increasing the value. Mm-hmm. So there are myriad factors that go into this. Like when we run somebody through it, you can do this on Value Scout, or you do, consulting assignment, however this unfolds. There's a process that you go through, sort of a checklist that is, you look at all of these different areas and try to understand where risk is present in the company and how that's influencing value. So that's variable number 1, R, risk. 2 is earnings. So almost invariably, if somebody is purchasing an asset, is because they expect some sort of return on that asset. And if we think about operating companies like marketing agencies, that return comes from cash flows, dividends back to me. So I'm willing to pay more for an agency that is giving me more dividends back. So when we think valuation, the risk-adjusted future cash flow stream is really what valuation is. Don't ever worry about trying to figure out how to answer that. That's what folks like me do the math for.
Right.
But earnings. So simply, if earnings are bigger, it's going to be worth more. We have less risky earnings that are bigger. It's worth even more than that. And then finally, growth. So growth is a function of earnings over time. If I'm looking at a company and every single year it's continuing to grow, like the earnings number's growing, and I'm looking at this and it presents little risk, that company is obviously more valuable than one that is just flatlining or declining. Because my expectation as a buyer is if I purchase Shawn's agency today, and I've seen this history of growth, and you can start to forecast a little bit, my expectation is next year, my earnings are going to be bigger than they were last year, right? So that just intuitively feels right, correct?
Correct.
So these are your variables, right? It is, on one hand, as simple as this is, those are your levers that you're pulling, earnings, growth, and risk. It's harder to actually do this in real life. We would all make earnings higher if we could instantly. It's hard to actually bring it to fruition. But those are the variables that we're pulling on.
Well, the next question that I usually hear is people saying, what should I get in return for my business? If I'm willing to sell it, if I'm taking these steps through, what's my walkaway price? And I'm interested in how you answer this. Now, I have an answer for this, which is, again, it's math, but it's back in napkin math.
So a couple ways to look at this. One, let's talk about back to my value versus price thing. We'll look at, how those two things might be constructed depending on how you go to market. And then we'll talk a little bit around multiples. And that, I think, is what you're talking about.
That's exactly where we're going. Yep.
It's a dangerous game, but we'll give it a shot. So, value analyzed. We think of that as like, what does the market as a whole likely to price an asset as? So pitching it across the middle of the plate. Mm-hmm. If you run a competitive transaction process, the expectation is that price will be higher than value. So that generally implies some competition, right? Like we've got to actually be proactive. It usually involves an investment banker. It means that the asset is attractive enough to actually get interest from multiple parties. And the expectation that it should be that price is somewhere, and there's no science to this because it's going to vary from, every single company to the next, but 20, 30, 40% higher than what that original middle of the road fair market value is. So to me, it highlights, back to the beginning of our conversation, like, should you hire a broker, in our case, an investment banker to run a transaction? Well, for X percent of having that expert in your corner working this process, one, it increases your surety of close. Their job is to be the sensei and the shepherd through this entire process. Two, they're going to run this auction. And that's where you really get the return, because it's impossible to run an auction on your own and get that level of competition. So that you get that separation from value to price. Make sense?
It does, if you explain to me, or for us, the auction as a process.
Yeah. So I hate to do real estate transactions because it breaks down. There's similarities in that, I want to sell a house. I hire a real estate broker. They could do a thing and it gets sold.
One of the things I've learned about M&A guys is they hate being compared to realtors, but it's the closest metaphor that most of us have to, like you said, something you've done hundreds of times. Most of us do never.
At the highest level, absolutely. It makes good sense. It just breaks down because things are very different between the assets and how a process unfolds, et cetera.
So recognizing I'm forcing you into this metaphor, please share with us what it means to take to auction.
Yeah, man, it's always pulling teeth, but I'll do it. Think of it as the open house. Right. And again, it's different because it's not like we have, 20 people that are going to show up to your agency and test the drawers and make sure the, faucets work and whatever people do at open houses.
Right.
It is led by your investment banker. They're going to go out and canvass the market. They're going to keep this confidential. We're going to start to try to generate interest from a series of different parties. We're going to solicit offers or LOIs from them, and then negotiate price and terms between those interested parties. That's an auction process, right? So it's not a guy standing on a milk crate trying to sell a cow, and doing that. I'm not even going to try to be an auctioneer. And it's also not, having the open house and a plate of warm cookies and some yummy smells to try to get more people in the door. But that's, essentially how it starts to unfold. So, but I don't want to lose the thread. That's auction process. You also wanted to talk about multiples and where that goes for agencies, right?
Well, and I wanted to share, when I say, here's what you should be making, and someone says, what's the absolute price for my agency? The answer is always, to me, that it's to be determined, right? That depends on so many things. But one answer I do like to give offhand is, I'll say, here's the math you need to know. How many years were you planning to work in your agency? And they'll say, if they're a guy like me, for 20 more years. And for the sake of round math, I'll say, what were you planning to pay yourself during that time? And they'll say, I was going to pay myself $250, and I look and go, okay, so it sounds like you would need to make 20 years of your life at $250. So you're looking at a $5 million sale. Like, that to me is back of the napkin, logical, you can sleep at night kind of math. When I sit there and say, if you're looking at what you're worth and you're trying to replace that kind of an income, let's put those kinds of numbers in your head.
All right. I think you're totally wrong.
That's fair. That's why we can have a healthy conversation, Dan, but you better support
I'll support it. Here's the thing. You can want that all day long. the market doesn't bear that. Full stop. Right? Like this is like, I've got a house that I absolutely love. It's this lovely house on a cul-de-sac. It's near good schools and whatever. And I want $20 million for it. Well, you know what? Houses in my neighborhood sell for $600 a square foot. And what I'm saying is I want 6,000. Like it's not going to work, right? Like I can want it all day long. The market will not support it. Full stop. So back to why it's important to understand value today. Well, if you have been sitting behind your desk thinking that, you're going to eventually sell this agency for 20 times earnings, you're smoking crack, man. Like it's just not going to happen. Like you have been operating with such faulty assumptions that it's going to materially impact your ability to transact.
Wow. No, it's real. And
it's from, man.
No, it's from experience, because I found there are a few things people want to talk about when they say, I have an agency that I'm ready to sell. And they're first having that discussion. They want to talk about all sorts of things. They don't want to talk about the things that I'm interested in. What does your management team look like? What's your longevity in the industry? Yeah. What services are you offering at what price points? That's the nitty gritty that I need to get into to help with that value creation phase. Here's what they want to talk about, Dan: timeline and dollar amount.
Yeah, totally understandable, right? Like that's what counts. That's what puts beer on the table. So let's talk about that a little bit though. Your analogy of, I'm planning to work for another 20 years, so I need 20 years times $250,000 is important math to do. I would just say that there's, maybe a different way to come at this. Number one, if you just own your agency forever until you die, you're going to make more money, full stop. Like you continue to do the thing, you harvest the cash flows. A multiple of those cash flows is not going to approach owning forever. So if that's what you want to do, your numbers are always going to come back out better to just keep it forever.
All right. So in our conversation here, let's call that plan A, or Apple. What you want to do is A, own that business. And you said this earlier, and stay with that business. Owning the Apple is the plan for the most eventual income from that business.
Yes. However, most people don't want to work forever, right?
We're going to call that banana or orange. And what I think you're telling me is that you can't force an apples to apples comparison between.
Wow. Didn't see that coming. All right.
You can't, when you're looking at an exit, you're not, your trade-offs are significant enough that it's not saying, hey, I want the same benefit I would have gotten if I'd run this business forever.
In my experience, the decision to sell is almost always driven around a lifestyle change. I am tired of running this business. I want to go spend more time with my grandkids, an infinite number of reasons. And the trick is to get the numbers to work and support your ability to go do the next thing.
Well, on a personal side, are those good reasons? Are those reasons I can get out of running this business? I just get tired of doing the job that I've been doing? I have employees that depend on me.
So this has been one of the most interesting things over the pandemic. We have seen more transactions of younger owners that are basically like burnout and stress as the number 1 and 2-ish reasons that people are selling. Whereas, once upon a time it was, I'm 66 and a half and, right. I'm heading to the end of the rainbow and my kids are, having grandkids, and like there was a very like tried and true way to do this. And oh, by the way, the way that you get out of business is sell it to your kids, right? That's why it's, George and Sons Plumbing. It doesn't happen anymore. So yeah, I think these are all totally reasonable, reasons to exit.
So if you're exiting for whatever your valid reason is, that, George's son doesn't want to take over the ad agency business. The key thing for me is there a point at which you're saying I'm ready? Right? Is there a point at which you should start looking into the exit planning mode, where a tool like Value Scout that you talked about, getting on and seeing what you're worth today and what you could be worth with those levers and changes down the road? At what point would you think an agency owner should know he or she is ready?
So I'm going to try to answer this, and we'll backtrack if you think that I'm not answering the right question here, but everything's about time. And the distance between your economic expectations today and what your goal is a function of time, your ability to close that gap. So I would generally say between 0 and 5 years is the window that you should be looking at. So if I want to sell today, like the first thing I do is not go to market. It's let's understand the valuation today. And if going to market makes sense, because if back to our, previous analogy, if I want $20 million for a $5 million thing, going to market isn't going to solve that problem. It's just going to be needless pain. So understand value today. Now, understanding how big the gap is lets me put together a plan. And one of the tools that we call this exit modeling, one of the tools that we go through is, all right, so if I've got a $10 million asset today and I'm looking for 20, we start to negotiate like, well, how many years are you willing to put into this to get to 20? So what's implied in these, in this is a growth rate. So if you have 20 years to build another $10 million of incremental value, that growth rate is pretty modest and it's probably doable. If you want to do this in 12 months, going to tell you it's probably impossible. So it's not a question of should. It's a question of being realistic and being intentional about goal setting, and then going out and attacking those goals.
I mean, you've talked about go to market before. What options are available? I mean, is there one method to do this, or are there a few different ways to approach the sale?
Yeah, there is a finite number of ways to approach a sale, and your ability to execute on them is also a function of size. So, if you're $100 million marketing group, or above, you can IPO, right? Like you can go public and get listed, and that's one way to actually exit your business. I suspect for most folks in the audience here, they're not $100 million agencies, and IPO is totally out of the question. So we're like, mortal stand, where most things, happen. Only a few exit options. One is what we think of as a third-party sell. So sell to a strategic, another industry participant, or sell to a financial buyer, which is usually a private equity group. But in either case, you are selling the company to an outsider. Probably the most likely way of exiting your ownership position. Number two is sell to employees. A couple of different variations on that theme. One is, you've got your right-hand man or woman, and they've been there for a while, and you're just going to sell to a single employee or to management. Another way to do it is an ESOP, employee stock ownership program. ESOP is only approachable if you have enough size. So generally, I tend to think maybe 2 million EBITDA is your minimum buy-in to effectively do an ESOP. Coming back to downsides of selling to management, to me, those are always high-risk transactions, and I see them fail incredibly frequently. They start off with good intentions, but the numbers never work, and things potentially get spicy between the now two adversaries as opposed to the two teammates.
Is it more a function, especially for that ESOP or inside sale? You said 2 million in revenue. Is it also a function of a headcount?
2 million in earnings.
Earnings.
Yeah.
You did say that.
Yeah. So the issue there is to execute an ESOP, it generally requires a bunch of third-party debt. So, and I don't want to get into the mechanics of an ESOP because that's a whole nother hour or two of discussion. But to create the employee trust and the employee trust to buy, the business or portion of the business from you, you got to lever up the company. And to do that, you need a company with steady cash flow and sizable enough to be able to service that debt on a valuation that is reasonable.
I mean, what I've heard is ESOP is a great idea. It doesn't tend to be the right solution for a service business or for agency.
I don't know that I've ever seen an agency do one. It doesn't mean that you can't. For me,
you can't.
Yeah, no. I tend to look at ESOP as like the ugly step cousin of transaction options. There's just a lot of overhead that goes with executing on one. You tend to see them in like construction companies, trades businesses. There's some industries that are sort of prone towards doing ESOPs. And I can't remember seeing one in this industry.
Yeah, for that reason, I don't think it's worth going through. But so you talked about IPO, you talked about an outside sale, and then a couple of variations on inside sale.
Yep. Your other options, and now we're getting down to like the end of the list, right? One is hire management and keep the company in your estate. So again, like this requires scale. And you kind of see where like the themes are going here, right? The bigger things get, the higher the valuation. I know we didn't talk about multiples yet. The higher the valuation multiple when things are bigger, and the more options you have. So if you want to hire in management and keep this company, cash flowing into your estate forever, well, to hire somebody that is good and trustable, and you've got to have a resilient, sizable organization. So retain management, keep the business in the estate, not you, because eventually you're going to die, but the estate is an option. You can give it away is another option. And the two ways that you typically see that happen is, one, I give it to a charity. Not many charities really want to run a marketing agency though. So there's some challenges there. Another variation of that is, we talked about estate planning earlier, slide a portion of ownership into the estate. But generally that also then implies that eventually you're going to sell the company. And that brings us full circle back to third party sale, IPO, et cetera. So it's generally not the final step. It is an interim step. And then our last option, and this is the final one, is die at your desk. That's it.
Yeah. That's the automotive metaphor of drive the car into the ground when it no longer turns on.
There are no other options for dealing with your, well, I take that back. The last option, shut it down. Just a wind up, a bankruptcy, what have you, is a viable option. So, but there's nothing else. There's no other way to get rid of it.
Well, and I've seen the hard thing in our industry is I've seen agency owners who get to the point where they'll say, I'm done. I had a good run. And they'll say a horrible thing like, I got my kids through college. I covered my bases. Nobody wants this business. I don't have somewhere to pass it off to, Dan. I'm hearing things like, it's time to just take down my shingle and be done.
Well, if you're a solo practitioner, that's maybe right. But it also feels a little sad. And if you're an agency that has employees, it feels really sad.
Yeah, I always look at that as that's a hard decision you're coming to, but it's not the easy way out. It's not easy either. I mean, there are conversations you're going to have that are painful. So let's take this out on an up note. Let me get you to talk
Sure.
about what we've all been waiting for. Dan, talk about factors that influence multiples.
Sure. Well, the one that is I alluded to earlier, and it's the hardest to get through is size. There is such a thing as a size premium. So you'll typically see, sort of like these tranches or, segments of, multiples based on size. If you're that, solo practitioner range, a couple person agency, multiples are low, 2-3 times earnings, maybe even less than 2, depending on, the agency. It's just not a pretty picture. So, back to your concept earlier that it's, 20 times earnings, 20 years of collecting an income, you're just not anywhere in the ballpark. In order to make this decision easier to sell, you probably want your multiple to be higher than a 2, right? It just would feel a lot better and you'd be able to make that decision a lot easier. So, generally, I always kind of think of like the $1 million earnings number, EBITDA number, is the buy-in to get to more approachable multiples. Still a wide range, still like a 3 to a 7 or a 3 to an 8. So, it highlights like, let's sharpen the pencil and figure out what this thing is actually worth as opposed to just using that range. Being at one end of the range or the other is like vastly different. Sharpen your pencil to figure it out. But you've got that like super small Main Street range that is the maybe below 2 up to 3-ish. That, we'll call it 3 to 7 for the, let's call it 1 to 5 EBITDA. And then when you're at like 5 to 10 EBITDA and above, you would expect like 6+ multiples. And that's, that number's going to go up as the size comes up. And where you like start to cap out is where public companies transact. So if you look at the stock price for, a public comp, as a public company, I couldn't really buy you, and if it's not accretive to earnings. So if I'm trading at a 14, there's no way that I'm going to be able to buy something for a 15. And again, but public companies generally only buy companies that are, appreciable in size to them. So, you're that $100 million enterprise, you can sell to a public company. Really, really challenging to do without some unique technology at the lower end of range.
No, I think you're telling us what we need to hear, and I value that. Are there certain factors that most contribute to having a multiplier or having a positive multiple? I mean, I think of things like when we look at it, there's certain groupings or sliders that we look at for as far as having protected IP or having a brand in an industry or having recognition in a market.
Yes. So let me go through what I think are the most important ones. Far and away, growth.
Okay. I think you keep making a very valid point.
But seriously, like if I'm going to, imagine that let's do this. Let's go back to this housing analogy that I don't like. Imagine that you're looking at 2 houses and one of the houses grew every single year. You want more
I see why the metaphor breaks down.
Yeah. But if you had a house that grew every single year, you'd be like, well, it's going to be worth more every year, right? So growth, the importance of growth can't be overstated. 2, recurring revenue is the holy grail. And if you think of, industries that have high components of recurring revenue or low churn in their customer base, they transact at high multiples, like insurance agencies. Generally, like once an insurance company, think about how many times you've changed your insurance company. Probably not a lot, unless you're a really bad driver and you get fired or something. So you think of that as churn, right? Like you're highly likely to just, continue to pay the bill every single month or quarter or whatever it is without ever thinking about it. High valuation multiples for those type of businesses. In marketing worlds, the more that you have sticky revenue that doesn't change, the higher that multiple is going to be. And then likewise, you're talking about IP and those sorts of things. To me, IP is important when it's creating a defensible niche. So if it's just a trademark, not really important. The brand name itself, not all that important unless it creates a defensible niche. So food for thought in terms of where you're allocating time and resources. It's that, it all comes back to my 3 variables: earnings, growth, and risk, man.
No, I appreciate very much getting your thinking on this because you're sitting on that side of the table looking at these from a different point of view as we, as an agency owner, we're seeing all this value in branding. We're marketers. We're looking at this saying, I'm owning my industry. I'm becoming recognized in my market. And that's a hard sell, it sounds like, when you're talking to somebody who's in the earnings growth revenue.
Well, here's where it either connects or doesn't. Does that branding yield revenue? So if you swapped out the name, what would happen? And the challenge that you might issue back to a client that's investing in these type of activities is, well, if we swapped out the name, yes, we would still sell because we have a great sales team. We have great marketing initiatives, all of the stuff that makes it hum. In which case, the brand itself is less important than the systems. But if you can rationalize how it's the brand that is driving that that revenue and the consistency, then it's important. And these are systems, right? So they interact with one another. But I would encourage you and agency owners to start to think of things that way. It's not just the brand in a vacuum. It is what it is enabling you to do.
No, I'm learning a ton from having this conversation. I'm getting a lot of value out of this. So I appreciate what you're putting out there because it is a different way of thinking through it. Dan, if I could ask what advice you would give to a business owner that's at a point where they're not at a fire sale moment, but they're looking to exit. They're starting to think about a potential exit for their agency.
Yeah, start yesterday, man. There's a phrase that I always say, and, it's a little cheesy, but best time to plant a tree was 20 years ago. The next best time is today. This is a activity that is going to take time. And, it's hard to find urgency around it's hard to find urgency around this when there's other important things that have, that are the fire drill for today. But if you don't start today, you're never going to start to make progress towards that long range goal. So you just got to build it into the DNA of how you go to work every day. And that's what separates, success from failure.
Yeah, I talk to owners who tell me I'm too busy running the business right now to worry about that. What's your response to I've got work to do, so I can't work on that?
Reevaluate your priorities.
I liked what you said earlier about 100% of business owners transition.
Yeah. I mean, look, I run a company. I run a couple of companies, and I intimately understand the firefight that goes on. The question is, as an owner, is my best use being above the fray or in the firefight? And I would argue for me, it is what I think of as up and out, the long range things that are moving the needle on, revenues, on long range value, on, positioning my companies for the what's next. It's not being in a firefight. So that's what I have people for, is to be in the firefight and, call me when you need me, but that's where my priorities personally lie. So if it's a client that you're talking to that is thinking about, hey, Shawn, I'm thinking about an exit in 12 months or 24 months or, maybe in 4 years. If that is truly the case, and it's not just, a hand wave, truly thinking about 36 months, you want to be on the beach or on a sailboat, well, then today you need to rethink your priorities to make that happen.
What are the odds of it happening without preparation, without planning, without having the right people involved?
Yeah. So the statistics are 80% of sales fail on the first attempt.
I feel like too often I'm speaking to business owners and that selling the business is on their nice to-do list. It's on the bucket list somewhere, but it rarely falls into a category of being urgent or important.
Well, what's generally more urgent and important is cash flow, right? Like your ability to increase cash flow and increase dividends back to you as the shareholder. Would you argue that, would you agree that that's important to most owners?
That's one of his primary responsibilities.
So if we go back to earnings, growth, and risk, if we do our job here, we are going to increase earnings and decrease the risk to that earning stream for the next couple of years. So why is there not urgency to this? What are you possibly urgent about in your business that doesn't look like more earnings?
Well, I look back at the guy that's taking down his shingle, that's closing up his shop, that's laying off members of his team that relied on him for, in some cases, they're planning decades into their future with that business. And my answer to you is that is showing the utmost disloyalty or lack of a priority to what your responsibilities are as a business owner. You're actually proposing, Dan, in a way that's a misunderstanding of your role as a business owner.
Yeah. So I'll tell you a quick story, and maybe that'll be a wrap for us. Had a former client, different sort of adjacent industry, family business. Let's call it a $5 to $10 million business. So small business in the grand scheme of things. Father is the president, fully owns the business. Son is working in the business, is like in his 40s or something. And for years now, they've been talking about selling the business, and it's never a priority, right? It's our busy season. No, we don't want to talk about this. Oh, we got to wait until whenever. There's always an excuse. And in this gentleman's case, it's a bit of a do-gooderness. Like he's always worried about his customers. And I've got to take care of my customers and make sure everything is going okay. So here we are sort of at the end of this. There's some health issues that are involved now, and it's gotten to the point where I think that this asset is not sellable. Like I have officially passed on the transaction. Like I'm not working on it. And the reason I'm not working on it is it won't put beer on the table, right? So despite his sort of do-gooder nature about this, I think the business is going to fail. He's going to put his son on the street, his son who's, experience is only in this business. It's a terrible, terrible situation. Had we, 3 or 4 or 5 years ago thought about this a little bit differently and said, you know what, in that case, maybe, we want to transition to the son and sell it, an insider sale as opposed to a third party. Let's build some resiliency. Let's do some like coaching around, kids management skills. Let's do all of the things that we would, have talked about in this conversation. We'd probably be in a much, much different spot. And, here we are showing what the impact of that lack of urgency and reprioritizing things is. It's just bad news. You've got to start today.
No, that story is so relatable because it is what happens when you get busy in the business rather than working on it, which is a flaw that is admirable. Yep. In so many other ways. We're in a time when the ethic of hustle and be busy and put your time in and work late at night is still being glorified by the business owner. And I think, there are voices out there, Grant Cardone, Gary Vaynerchuk, there are voices out there that are glorifying that and encouraging that hustle culture. And unfortunately, you can only hustle so much and for so long.
It's playing small ball, man. Like you can hustle and be a solopreneur and do totally fine. But for the most part, you cannot be a founder, a president or CEO of a company and get by hustle. It's playing small ball.
Well, Dan, what I'd love to hear is maybe a success story or a relatable story that's that fits of someone that's done this right, that's seen what's coming.
So just yesterday, day before, I had a conversation with a couple, a client of ours. Started working with them maybe 4 or 5 years ago. Started with Valuation, did some value creation consulting work. They started to like reposition the business. They're young. They're in their 40s. Wanted to make a lifestyle change. They kind of looked at each other and said, one, this is stressful, and we bring work home, into our marriage every single night. Like, this is not awesome. And the business was getting, too big for them to be comfortable managing. So that process, took a couple of years to unfold, went to market, ran an auction, sold for a nice 8-figure number. And I just talked to them. They bought a house down in Florida and they moved and completely changed their life. That is the other side of this. That's what success looks like, is they have created the optionality to do whatever the heck they want next. Or, does this mean they're never going to work again? No, they're entrepreneurs. They're excited about new ideas. They're, poking around at, what their next venture is. But that's how the end state of this can come about, with some forethought and intentionality.
Well, can I ask some focus questions again? Keep it anonymous. This is your own client, but about how long did that process take?
Yeah, again, it was probably 4 to 5 years from that very first engagement through to their sale. And again, running a sale process is, I don't remember what theirs took, but average 9 months. So they spent a couple of 3-ish years getting ready and dressing the company up and positioning well and growing earnings, growing top line, creating some resiliency, and then we'll call it 9 months on market to get to a closed transaction.
So 4 to 5 years from when they had their first engagement with you, how long had they been weighing it over or deciding to do it or to not do it, prior to that, in that it's on my to-do list, it's on my bucket list, I'll get to it eventually, right?
Yeah, I don't know. So I don't know what happened prior to us getting, started, like how long they were thinking through this. But, it was just the stress of running a business that created the initial conversation. It wasn't, hey, I'm ready to retire. It's, I'm ready to do something different, but I want the benefit of, the financial compensation for this awesome asset that I built.
Well, can I ask how many people they had in underemployment at the time? How many people did they take care of with that transition?
50, 75, I don't know.
So yeah,
that's not a small number.
No, it's a strong contrast to being a responsible, and taking that ownership. Again, I always say there's the word own in ownership is interesting because it could be your own, or it could be what you are, own from the term of that's your responsibility.
And take it a step further. So those, we'll just call it 50 people, whatever it was. In a transaction, there's always this concern that the buyer's going to come in and fire everybody. And frankly, it almost never happens. So in this case, the buyer came in and hired more people, right? Like immediately, the first thing that they did was bring in more people. So it just creates more opportunity. And oh, by the way, buyer, bigger company. Now, every one of those single employees has more career opportunity to move into different roles in a larger enterprise. So it's not a situation that there's a potential negative here of, our whole workforce is going to get fired and, a bunch of consultants are going to come in and like reallocate. No, not at all. Like we just added more people and gave them more opportunity.
Dan, those are great examples. I really appreciate your experience in this, your expertise, and your willingness to talk candidly and thoroughly about this decision. We've talked before that it is your number one asset. It's the biggest thing people create in their lives. It's your life's work, and it becomes an emotional topic, but it also needs to be handled in a way that is dealt with complete professionalism. I think that's what I learned from our conversation today.
Indeed. It's been a pleasure.